Hello and welcome. My name is Oscar from the Finance Society at Stockholm Business School. Today we're going to talk about the head and shoulders pattern in the technical analysis. It's a pretty common pattern and a very powerful reversal pattern. With that I mean when the stock's going up and it just changes direction and goes down. That's a reversal. This is one of many reversal patterns that will give you a clue that this stock is going to reverse and go the other way. It's a very old setup or a pattern. I don't dare guess how old it is, but I know it's very old and it's like Old Faithful. It usually works. As always, nothing is 100%, but it's a good pattern. And as you can see here, I've drawn these beautiful pictures. Just think as these as the chart. We have the stock going up, going down. That's the shoulder. This, you can call this the armpit. So you have a shoulder, an armpit, and a higher top than the shoulder. That's the head. A lower low, or a higher low, I should say. That's the other armpit, and a new top, which is lower than the head. Doesn't have to be lower than the other shoulder, but it needs to be lower than the head. That's the shoulder. And then we have the breakthrough. If you connect the two armpits, you have a neckline. This neckline is very important because when you break the neckline, the head and shoulder triggers. So when you break the neckline, you can activate the trade or you wait for the retrace. And we will get into that later. This is a very picture-perfect head and shoulders. Not many look like this in the real world. They are usually pretty ugly. But the better the symmetry with the size of the shoulders, the gap between this side of the shoulder and this side, the better symmetry with this shoulder and this shoulder, and in comparison to the head, the better the pattern is. I don't really know why, but just symmetry is always good. And we have the same thing here in the reverse head and shoulders, or inverse. You have a down, up, that's shoulder. Just this pattern flipped upside down. You have a head, lower low, and a shoulder, a higher low, and you connect the armpits, you have a neckline, and you break through. So the general gist is, when you see this pattern, when you break the neckline, you take the trade. Your stop out, that means when you close a position, because you were wrong, is when you close, remember close, above the neckline. So this can be on a 10-minute chart, a daily chart, a weekly chart, whatever. But as soon as you break it, you can either take it, and if you take it, you need to stop out when you close above the neckline again. What you can do as well is you wait for the retrace. You break it through, and you wait for the price to touch the neckline again. And as soon as it touches the neckline, or it's very close, then you go, in this case, short. That means you have a smaller stop loss. So if you short it here at this black line, that makes maybe the stop out to here is like $2, and you close. So let's say your risk $3 a share. If you just wait for this to come closer to the line, the smaller stop out, the less risk you take, and we like taking small risks. If you wait for the retrace, of course you're gonna miss some charts that's just gonna plummet. But again, I rather have a small risk than have the big gains. Same thing here. When you break through, you either take it straight away, or you wait for the retrace back to the line, and then you go long. The slope of the line is very important. In a normal head and shoulders, you want an up-sloping line, and in a reverse or inverse head and shoulders, you want a down-sloping line. So if you want the stock to go down, you want an up-sloping neckline. And if you want the stock to go up, you want a down sloping neckline. And now we're gonna look at some examples. And we're gonna look at S&P 500. This is from 2012 and the beginning of March, I think. So let's look at it. It's the daily chart as well. And we have the first shoulder here. Down here, you have a head. And you have a shoulder. Boom. Here's your neckline. Pang. So, shoulder, armpit, head, armpit, shoulder, and you break through. Here you break through. You go down and you come back close to the line. You don't really have to touch the line, but you're close to it. So either you take it straight here when you close under. That's a little bit messy, or you take it when you start getting close to the line, because as I said, your stop out is any close over the yellow line. So in this case, let's say we got in here. We get in here. So our stop out is any close over this yellow line. And our profit, how far do you think this is gonna fall? Let's see what we have learned from before. We have the 200 here. That's a powerful support. Maybe we can find something else. With the 200, we have a pivot top and a gap as well. So this would be a good level to exit. But with head and shoulders, there is a method of calculating not the exact price, but a guideline to how far you're gonna wait. So you're gonna take the top of the head down to the neckline. In this case, it's from 1420 to 1353. So let's say 1350 just for fun. So it's 70 points, and then we're gonna take from where we broke it. That is, in this case, 661, and we can see that the bottom is 1291, so exactly 70 points. Maybe I was lucky, but this seems to work. So you take the top of the head down to the neckline, add it up, and you have your target price. What you wanna when you wanna close out the trade. Of course, you can close it early if you just wanna minimize the risk. But in general, this should work in general. Nothing in technicals are an exact science. So, but it's a good guideline. Yeah. And now we're gonna look at Axe Food. Yeah. Here we have an inverse head and shoulders. Here's our shoulder. Here's our head. Here's our other shoulder. So what you do is you don't really see the other shoulder before it's too late. So you just see this shoulder, head, start of a shoulder. Then you draw the neckline. And as you see, we never close above this yellow line. This is a red bar. That means we gapped up above the line overnight, but we closed under the bar, under the yellow line. So we never closed above it. Here we closed above it. Sorry again. Here we closed above it. So either you wait for the retrace, which in this case never happens, or you go long here, you calculate, Jove, and you see that in this area of 243 should be your exit. This area here. As you see, we never really get there. We're close. So maybe you shouldn't calculate it to the penny, but in this area, we should get towards this area, and we are actually, we're 1 crown away from it, and that's just like 0.3% in this case. So it's pretty close. Of course, as I said, it's no exact science, but it's a general rule. I myself wouldn't have taken this trade because I like the retraces. I will show you another live chart from Netflix. Netflix, where are you? Here we go, Netflix. This is a bit of a messy chart, but we can make it work. Whoops. Weekly, badam. Here's a good head and shoulders. Shoulder. Head. Shoulder. Connect the lows. We break through. As you see, shoulder, head. Head is higher than the shoulder, and the next shoulder is here. So we break through. Let's say we buy on the breakthrough. We don't wait for a retrace. We're now in at 335, and we calculate that the downside is almost $80. Now it's even more. It's a quick calculation. That is $120. So it's a big down. We're waiting for a big downside move, down to the 200 ish. But as you see, we go down a little bit, but then we go up and we close above the yellow line. And what do? We stop out. So yeah, we would have lost, but we would only have lost $10 a share. And if you would cheat, yeah, you would be rewarded with a small down move to the downside, but you wouldn't sell. You would just wait for the 200 moving average, which, as you can see, never happens. We go up, and you get punished. So you need to follow the exit rules as well. And yeah, that was the head and shoulders pattern. I hope you learned anything. And as always, see you next time. Have a good one.